Welcome to the 61st episode of our Crossing Thin Ice podcast series, where twice a month we tackle risk management topics. Our aim for these podcasts is to help with your ERM program and general risk knowledge. We encourage you to share with anyone interested in lifelong learning about risk management, and we welcome your feedback. My name is Max Rudolph, and as always, I'm joined by Dave Ingram. Dave will be sharing his thoughts today on how to think about balancing risk and return in the real world. The academics give you proxies based off price and uncertainty, but don't cover the range of difficulties a practitioner will encounter during the actual analysis. You'll be able to take this back to your desk and implement. Let's get started. As a reminder, nothing in today's podcast is intended to be investment advice. We're here to provide educational material on risk topics without getting lost in the weeds.
It is common knowledge that in order to get higher returns, you need to take more risk. Investors are risk averse, and they will only fund riskier ventures if they can have higher expectations of returns. This idea is a basic part of the discussion between an investment advisor and the investor. The risk tolerance discussion is fundamentally a risk and reward discussion. This concept has become so ingrained that it has gone from the investment arena and it is now used as if it applies to all business decision making. That's a problem, because in general, reward doesn't come from risk. It comes from good judgment, good timing, and good execution. The situation where reward is primarily determined by the level of risk is actually a very special case that does not even always apply in the investment arena. Let's start by going back and recalling where the idea comes from. It was first mentioned in the 19th century economist Alfred Marshall in his 1890 book, Principles of Economics, where he says that in all undertakings in which there are risks of great losses, there also must be hopes of great gains. You might notice that when he talks about this idea, he only suggests that there are hopes, while modern discussions have elevated that almost to a guarantee. The next economist to deal with the concept was Frank Knight, who in 1928 posited a formulaic relationship for risk and reward, but only after he defined risk to be about known probability distributions, which is a condition that in my mind actually only applies in casinos. Everything else he called uncertainty, where all bets were off. Go forward a few decades, and in 1952, Harry Markowitz proposed modern portfolio theory, or MPT, which is the framework that we are still using when we think about risk and reward. Modern portfolio theory has us thinking of the efficient frontier and an idealized portfolio that blends different amounts of stocks and cash to get the risk-reward trade-off that we want. There are a number of underlying assumptions to MPT. Central is that the stock choice here is a bundle of stocks that are in the aggregate priced exactly correctly at all times, also known as the efficient market hypothesis, EMH, which automatically places all of the investment choices right on the efficient frontier. But the risk-reward trade-off that we all seem to want to count on exists only on that efficient frontier. Real businesses do not in fact operate on that frontier. They have inefficiencies, competitors, incomplete knowledge, and changes in suppliers and customers and employees that all are less than perfectly accounted for in their business strategy and operations. I'm not actually thinking of this in terms of investing in a real business via the stock of that business. I'm actually thinking of the actual earnings of the business. What I'm saying here is that the real earnings of a real business are not usually on the efficient frontier. So if you look for any individual business on the risk-reward plot, they exist somewhere in that vast area under the curve. If they add risk, returns could go up, they could go down, or they could stay more or less the same. The only constraint on their future position is that it will not exceed the efficient frontier, and that's not always true either, because they could invent some transformational approach to their business that moves that frontier. One reason why their earnings could do something other than go up with increased risk is that the amount that they spend taking the risk might be more than the expected returns from the investment in the risky activity. Let's take an example of a pizza parlor. If they add another oven, they may pay more for the oven than the amount of additional pizza that they can sell. The investment in a new oven has a negative expected value then, which means that it was a bad judgment to make that investment. Another reason that the investment in the oven does not produce returns proportionate to the risk that they're taking is that they buy the oven in the late fall. Their business depends a lot on foot traffic, and foot traffic is often down significantly in the winter. They had to borrow to finance the purchase of the oven, so after the cost of financing, the oven purchase is underwater for several months, and sales in good weather are never high enough to make up for those initial losses and interest. That's bad timing. And a third way that the oven might not produce returns commensurate with a risk is that they do not end up installing it properly, and when they first use the oven, they operate it improperly and ruin a section of the cooking surface. Their execution is poor. Getting a profit out of any new and most old business activities requires three things to go right. There needs to be good judgment in selecting the specific activity. The choice of when to do the activity needs to be made, and that needs to be a good time, and they need to have both effective and efficient execution of the fundamental aspects and most of the details of the activity. If a business can be sure that they can get these three things right, then their business choice is on the efficient frontier, and then they can worry about risk-reward trade-offs. But to worry about that, they need not just one choice that is on the frontier, but several, so that the risk-reward discussion can involve choices. But before you immediately go with the conventional wisdom and do that, take an honest look at your business operations. Are you really making choices with near perfect judgment all of the time? How good is your timing? And your execution. Are there aspects of your execution that could be significantly improved in either effectiveness or efficiency? If you have any of these imperfections, which almost all real businesses do, then working on improving your judgment, timing, and execution is your best route to getting better returns. And risk is merely a fourth concern.
Dave, you mentioned that a business's real earnings are not usually on the efficient frontier. What metrics or frameworks do you use to evaluate business opportunities, considering they likely exist somewhere in the vast area under the curve?
Well, Max, I can give you a real life example from when I was doing pricing work as an actuary, trying to use these ideas. I was trying to work with the marketing folks to develop a new variation of a deferred annuity product. And there were a lot of knobs that I could turn on that in terms of what kind of surrender charges there were, what kind of loads there were on the product, what the margins were, how you set the interest rates, how you invested, lots and lots of different possible combinations. We had an approach to pricing at that time where we looked at the return on investment for the product. So I would build a model and vary all those different possibilities, and I came up with 20 or 25 different variations on product design. And I plotted the risk versus the returns for those 20 or 30 variations, and they formed a cloud of data points. The efficient frontier, in theory, is the line that sits on top of that cloud, and there clearly was a boundary to those points, and the boundary did fit the theory for how that should look. Among all those points, one of them was our existing product, and it was far away, let's say, from that efficient frontier. And so the discussion with the marketing folks became, okay, let's look at all the points that are in between the current product and the efficient frontier, and which of those points, and each one represented a different set of features of the product. And so which of those sets of features was the one that you think that you could do the best job of selling. That conversation went extremely well. They were totally willing to buy into the idea that we wanted to move closer to that efficient frontier, especially when they had choices, and they had a lot of choices. That was one example of how we used this idea and used the fact that we didn't expect to be on the efficient frontier, and we didn't necessarily expect in our existing product, and we didn't necessarily expect with our new product to be all the way onto the efficient frontier.
That's an interesting example because you just end up getting closer to the efficient frontier, no matter what choice you make, because those are the options that you have, and you have a discussion with the marketing folks. That's brilliant. You also had a great example of buying an oven for a restaurant. Can you share a similar example that's tied to insurance?
Well, I can show sort of an example of something that went wrong there tied to insurance. And this was a situation. I worked with a company as a consultant. I think I was working with a company when their parent was trying to close up the company and sell them off. This company had brought a new variable annuity product to market in around the year 2000. Maybe it was 1999. One unique feature that they offered in that product was that they had a wider window for issue age for the annuitants. They allowed older annuitants than any other carrier. As was common in the market at that time, and probably still is, they had a level charge for their guaranteed minimum death benefit, a level charge for all ages, certain number of basis points. They price that by looking at the expected age distribution for their new customers, projected it out over time. Of course, their customers got older every year, so created an average mortality rate over the expected life of the product, and created a mortality charge or charge for the death benefit feature that was based on that. Well, that was bad judgment. Their distributors reacted to that different age window by placing all of their older customers with that product, with that company, and all of their younger applications with a different company whose product had a lower charge. You can imagine that's just classic anti-selection. And they had bad timing. I said they did this in 1999, maybe it was 1998, I forget, but before they'd done it for too long, the stock market crashed. The dot-com bubble burst, and all of their guaranteed minimum death benefits were in the money. So people still had to die to get that benefit. So it wasn't, a huge thing. They were talking about a group that was average age 70 instead of average age 64, 65 that they had projected. There's a significant difference in mortality as you get into those age ranges. So they experience quite a bit higher claims, and then finally they had poor execution because they knew fairly soon after they issued that product that they were only getting applicants from those older ages. And they failed to act on that. They could have changed the product. They could have pulled it. They could have done a lot of things, but they chose to just keep accepting the business. So they had bad judgment, bad timing, and bad execution.
Yeah, it doesn't really help to have a leading indicator if you ignore it.
Yes.
My old story of going up to the new issue area and asking how high the pile next to their desk was of applications. And when it got too high, then starting to say, well, maybe there's a problem with the way we priced the product originally. Um, yeah, no, that's interesting.
So, Max, let me ask you a question. We've talked about definitions of risk and reward from Marshall and Markowitz and Knight. What are some other ways that you know of for looking at risk?
Well, there's quite a few. Let me talk briefly about three that I kind of like. Howard Marks is an investor. Generally, he deals with high yield, but he writes about a lot of stuff that I think a broad group of investment professionals is certainly interested in. He put out a paper not too long ago where he showed visually, as if you're looking at CAPM and that straight line showing higher risk, higher reward, but then he overlaid distribution charts, PDFs on it, showing that the further you get out, the more risk there is, the broader that distribution is. So at a low risk point, you might see a very tight distribution of results around that. But as you go further out, the distribution becomes much more broad. So you have much more chance of both good things happening, but also of bad things happening. And I found that really, really useful.
So, with what Harold Marks says there, Max, if I'm hearing you right, is that the more risk that you take, the looser the connection between risk and reward.
Right. No, totally correct. You know that I like to talk about Warren Buffett, and his rule number one is don't lose money. And then he has rule number two, which is notice what rule number one said. And it just doubles down on that. It's where he looks at just not having positive results. And then the third one that I think is probably the most useful is falling short of a goal. So some people will look at this as for looking at pricing, it'll be whether the number is positive given an opportunity cost of capital. From an individual perspective, I like looking at it as, what if do you have enough money to retire? And so looking at where you're at relative to your goal. My rule on that one in particular is calculate your number and then multiply it by 2, because markets are known to drop by 50%, probably 2 to 3 times during your working lifetime. And the worst possible time that can happen is on the day you retire. And so if you have twice as much as you thought you needed, then even if that bad event happens, that you can move on and still have a successful retirement. So those are a couple quick ones that I find interesting.
With Buffett's rule, it's a nice rule, but he's pretty transparent. He has done things that have lost money. So what does that mean?
Well, it means you're setting up a goal. It's not a rule. He calls it a rule, but he really doesn't mean that. And most investment professionals will tell you that if you're trading and you get 55% right, you're going to be incredibly rich. His numbers are way higher than that, but they certainly aren't at 100% correct decisions. He's made a number of mistakes that are pretty readily apparent in hindsight, sometimes hard to see at the time. But overall, his results have been really strong. But he's become much better known as an educator of investors at the retail level, I think, versus somebody that you go to as an investment professional. As somebody who interacts with a lot of investment professionals, I find a lot of them kind of consciously avoid doing the things that Buffett does. Some of them are successful in their own right. We hope you've enjoyed this episode of Crossing Thin Ice. Higher risk does not guarantee higher returns. Plans related to judgment, timing, and execution should be added to your previous risk plans if you want to succeed in the real world. If you found it valuable, please like, subscribe, and share with your colleagues.